Michael Gomez, and I'm a real estate broker and an investor here in Nashville, Tennessee.
And I'm Seth Mosley, Grammy Award-winning songwriter and real estate investor.
We host a monthly meetup in Middle Tennessee for anyone who wants to build passive income, not only for retirement, but for today.
On the first Wednesday of every month, we bring in an expert from every area of investing to help you with things like finding deals, getting your financing locked in, asset protection, every kind of investing, so much more.
Our videos are all about delivering that content to you.
Go to musicandmoneyig.com for more info on our free monthly events. Hit subscribe on the page so you don't miss any awesome content, and hit that like button if you like it.
Don't let all the flair of my jacket distract you.
Here's the content.
How's everyone doing? Can you guys hear me okay? Yes. Oh, good. I thought I was going to have a little bit. I hate hearing my voice, but anyway, thanks so much for being here. I'm really impressed that you guys are here at 8 o'clock in the morning to listen to a lawyer. That's impressive. Now, I am a lawyer, so if maybe you guys didn't know, that's why you guys showed up, because I didn't know there's a lawyer. So I am a lawyer by trade. I'm actually a syndication attorney, as some of you may know. So I help real estate investors basically go do bigger deals. So I've got clients who are doing the single family, kind of what Michael was talking about, and then they want to go do bigger deals, but get a building, a multifamily, and they have run out of money, right? Anybody had that issue already where they want to keep investing, but you run out of money, right? So we never want to have that, impede your progress. And so what I do is help clients find other people's money, right? We pool other people's money so we can go do bigger deals. And we do it in all kinds of asset classes. I'm primarily in real estate, but I've got clients who obviously most of them are in multifamily, but some are in single family, and some are in mobile home parks, which we're going to talk about today. Some are in residential assisted living. I think we'll talk about it in a second. Some are in self-storage. Anybody in self-storage? It's a great asset class. But I get to see all these asset classes. So today we're going to focus on Mom was here, who dabbles in mobile home parks and also some residential assisted living, also multifamily. I think Carl Dean was here too. Carl's in multifamily. So anyway, I've got a lot of respect for this guy. So obviously I'm joking. So who's never seen me? I assume most of you's never seen me do my spiel, right? Anybody seen me speak? Other than, I know, all right, okay. So let me just tell you quickly about my story, just so you can kind of see where the context is. As Michael said, I'm originally from Santiago, Chile, and I came to the States about 30 years ago, because I am now 45, even though I look like I'm 12. But I'm 45, so I came to this country 30 years ago, and went to UC Berkeley. Any Cal grads? Woohoo! One more, go Bears, thank you. So I went to Cal and then went to law school down in LA, Loyola Marymount Law School. And then I did what every lawyer dreams of doing, which is I went to work for a really nice law firm, which was great. And I did securities work at the firm, but in the form of litigation. So my job was to basically go to trial, do depositions, motions. I mean, anytime what hit the fan, that's when I would get the case. But I was working at a really great firm. I don't know if I'm sure a lot of you guys have good jobs that you kind of enjoy. I was in as law firms go, it was a really good gig, but I had the issue where I would literally get up in the morning, I'd shower, I'd get dressed, I'd get in my car, I'd drive to work, I'd work all day, I'd drive home, get back to the house, maybe watch a little TV, eat, maybe go to the gym, not often, and then I'd do it all over again. I'd get up in the morning, I'd do it all over again. And I just felt kind of I was trapped. I was in what I now call the rat race. Anybody feel like they're in that situation where you're just kind of trapped in what you're doing? This part of the story, because literally 3 or 4 days after I got back from Miami, I'm driving in my car in Southern California, and I hear Robert Kiyosaki, the author of Rich Dad, Poor Dad, do a drop-in for the real estate guys. The real estate guys obviously have a podcast, and in those days they were primarily on the radio. And I said, hey, this is Robert Kiyosaki, author of Rich Dad, Poor Dad. If you're serious about investing in real estate, check out the real estate guys. They really know what they're talking about. And if I hadn't picked up that book, that radio spot would have meant nothing. But because of that, it triggered and found out about the real estate guys, and I went to one of their events, and that also changed my life. But I eventually went to work for those guys, and that's why I'm so fond of them. I've known Robert. I'm his personal attorney. I've known him now for 12, 13 years. Russ was doing all the legal work back in the day, and he came to me and said, I'm doing all the legal work. And I said, you shouldn't do that. So they ended up hiring me. I went to work for them, and that's how I've really just super blessed, because that's how I've, number one, got out of working at the law firm. But more importantly, got to meet so many amazing people, including Seth and Michael. Those are obviously relationships that basically every relationship I ever have now is traced back to the real estate guys and Robert. Even me meeting my wife there's a story behind that and how it all feeds back to Robert. So so that's what I've been doing up to now. And then literally about 2 years ago, I moved to the beautiful country of Belize, believe it or not. So I spent 2.5 years living in Belize, which, if anybody been to Belize? Oh, wow. Wow, pretty cool. Can I move this, because I'm going to need the clicker. Can I move this, because I wanted to show a couple of pictures. So I moved down to Belize. I was, Robert, I'm sure he talked about it when he was here. They have a development down in Belize, a resort product, kind of a condo hotel. And I was working for their company as general counsel, so I was negotiating all of their deals, and they ended up partnering with Hilton Hotel. So I had the privilege of working and coordinating that effort. But here I am. I'm in Belize. The Blue Hole, right? One of the wonders of the world. Just beautiful setting, and I'm just living a pretty charmed life, right? I got a pretty good practice going on. I'm pretty relaxed. I got my wife, my 2 kids with me. Everything's great. And then May of last year, I decided to leave all of that to come back to the United States, and specifically come back to help a buddy of mine, Andrew Lanois. Anybody know Andrew? He's kind of in the music world. He's a former William Morris agent. Andrew Lanois had started a mobile home park company, and he had scaled it. He started from 0 to basically becoming a top 100 owner-operator in the span of like 18 months. Crazy. But his goal was to take it from top 100 to top 10, top 5, which is a huge scale. And so he called me and said, Mauricio, I'd love for you to come on board, help me scale this mobile home park company. I just talked to another gentleman by the name of Mike, who I don't think you guys know, but he's in the construction world. And he said, I want to bring you guys together, and I want to help me scale this thing and just take it to the moon. And so that's the reason that I left Belize, believe it or not, and came to work temporarily for Andrew in Four Peaks Capital Partners. I'm not there anymore, but the presentation that I'm going to give you was done by me while I was in that capacity. I was a managing partner at Four Peaks, in full disclosure. It turned out to be a little bit too hectic for me, working for a startup, having the law firm, having a brand new family. There's nothing more important to me than my family, and I just realized, hey, I got 15 years. My kids are 3 and 1. So I'm like, I got the next 15 years to enjoy my family. I don't want to spend the next 10, 15 years just working, burning the midnight oil or the candle at both ends, whatever it's called. I want to enjoy my family. So we ended up kind of parting ways. Still, best of friends. He still is, and remains the godfather of my youngest child. But that's kind of the background. So I'm here just to kind of present the space. Obviously, never here to sell anything, especially this time, because I'm really here, really because of Seth and Michael, because they asked me to come, and I wanted to add some value to you. So a lot of my friends said, well, you're crazy, Mauricio. You're living in Belize. You've got this great lifestyle. You've got everything great. Why in the world would you come back to the States and deal with mobile home parks? And I've got this little graph. You know what? Getting old, man. 45 years old, and I need glasses now. So otherwise, I'm not going to be able to see anything. Another picture of... if you guys go to Belize, if you go to the island, you've got to take a picture in a hammock otherwise. So what I'm going to show you is this graph, because I think this graph is really, it just kind of shows you why mobile home parks, in my opinion, right now is the best asset class to be in. Better than any other asset class in the world, right now. I don't know how long it's going to last, but right now this is it. This is a chart. I'm going to show different asset classes within real estate and show their NOI growth, net operating income. I want to make sure no investor left behind, but NOI, as Michael said, a lot of single-family guys don't know what NOI is. NOI is simply taking your revenues or your income from the asset, subtracting all the expenses, you end up with net operating income. That's before you take out the loan, the mortgage that you probably have, and some tax, obviously the taxes, but that's the income of your property. So this graph shows NOI growth. From 2000 to 2015. So that's the apartment space, right? That's what most people are in. That's the trajectory of the NOI growth in apartments, which is pretty nice. That's the industrial space, which is a little bit better. And then you've got malls, strip malls. I don't know too many people playing in the strip mall space. Those are usually more institutional investors, but that's there. Office space. If you guys notice, again, real estate, everybody talks about real estate, but real estate is not only is it geographically important, like the real estate here in Franklin, Tennessee is vastly different from the market in San Francisco, California, right? So real estate is local, but also asset classes. Everybody talks about real estate in general, but there are so many different types of asset classes. Who would have thought of mobile home parks if you hadn't heard of it before as a potential investment opportunity as an asset class? It usually doesn't show up. There's a strip mall, sorry. There's self-storage. I love self-storage. It's one of my favorite asset classes. You don't have to deal with any tenants. They're just boxes, and nobody complains. The revenue is really nice. But here's mobile home parks. the red line. And can anybody, obviously, probably gives it away if you're reading it, but obviously it's the highest performing, but anything that you guys see on that graph that kind of stands out, other than the fact that the mobile home park line is at the top of everything? Every year we get to deduct, if you divide 100,000 into 27.5, I've done the math already, it's $3,636, right? So this property every year, according to the government, loses $3,636 every year, even though the property is probably going up. So what that means to us, most likely, especially if you do it right, and this is what I encourage you guys to try and do, let's say this $100,000 is spitting off, I don't know, let's just say it's a 10% return, so it spits off $10,000 a year, and then by the time you get all your, you pay your debt and all that stuff, you're down to, let's say, $3,000, okay? Ordinarily, you would have to pay $3,000 in taxes. If this was a stock, if this was anything else, you would have to pay taxes on that $3,000. But because we've got the loss, we actually take the loss here of $366, you've actually technically lost $636. Even though there's been money in your pocket, you've actually lost $636. And it gets even better, because not only do you claim a loss, but you can then offset this loss with other income. So most of us have day jobs when we start investing, so whatever money you're making in your day job, you actually get to deduct this from the ultimate, your income that you got from your job. So depreciation is hands down an amazing tool. And what's great about mobile home parks, because look at this. Let's just assume that instead of 27.5 years, we could depreciate it faster. Let's say we could do it in 10 years, right? That means if I had $100,000 divided by 10 years, that means I got $10,000 a year that I could deduct instead of 336. So a quicker depreciation time is better, right? In mobile home parks, there are some, and this applies to everywhere, but there are some things you can actually depreciate faster, right? So property, 27.5, but if there's some things like roads that you can depreciate at 15 years, and there's some others that you can actually depreciate over 5 years, and those are like blinds, if you know your carpet, your blinds, or whatever. So a lot of people like to do what's called a cost segregation study. I'm not going to get into detail, but that kind of breaks down what you paid for every item, so some things you can depreciate faster. Well, one of the nice things about mobile home parks is mobile home parks are really like mini communities. Right? You've got roads going through your communities, you've got fencing, you've got lighting, you've got all these things, and so you can actually depreciate a mobile home community much faster than you can a multifamily or single family. So again, one of the nice reasons to have the mobile home parks, just again from a pure tax perspective. And again, I don't want to say that I would agree with Robert Kiyosaki, Rich Dad Poor Dad. He says you should never have, what's the saying? You should never have the tax tail wag the dog, or whatever the saying is. I'm screwing that one up. But you never want to make decisions purely based on tax law, because tax law can always change, right? And so as we know, we just had a tax change a few years ago. So that's number one. The second one that I love, and this is probably my favorite, is what's called the 1031 exchange, right? So it's actually possible for you to own real estate, sell your real estate, and never pay capital gains taxes ever. It's kind of a deferral, but what I'm doing in my life, and what I would encourage you to at least think about, maybe this is a paradigm shift or not, but my goal is to acquire as much real estate as I can in this period of my life, right? So I'm going out there and I'm buying. I started with single family. I've got some resort stuff, multifamily. You accumulate that either with your day job funds, or maybe you become a real estate investor full time, but you accumulate that. At some point, when I'm done, I want to cash in all of my equity, and I'm going to go buy one big building somewhere in the country, or two big buildings in countries where maybe the property values don't go up that fast. And I always think of like Cincinnati, Ohio as kind of my poster child. So in Cincinnati, the real estate, it might chuck along, it may go up 3% a year, 2% a year, but it's not. But they're cash cows. They're from a cash perspective, they produce the ratio of the cash they produce from the amount of money you buy the property for is huge. And so it's very difficult to actually build new mobile home parks from scratch. You've got to sort of go out into the outskirts of town where people don't really care, and that's how you would acquire a mobile home park community, a new one. Similarly, people who already have done that, where they went out back in the day and bought something, as that city expands, what do you think happens to those mobile home parks? They get gobbled up by strip malls or real estate developers who want to now that we've expanded our territory, people actually want to live out there in the outskirts of town, and so they are buying these mobile home parks so they can basically tear them down and build new residential or new whatever, strip malls or whatever they're going to do. So the demand is there, but the supply is there. And anytime you have a supply and demand imbalance, you know you're in for good stuff.
You just wish you could save more money in taxes every year.
Michael, I wish every year that was going to be the case. So how do I save money?
Oh, my recommendation would be to find a CPA that's also great at everything real estate related, that understands real estate investment.
Chris Picurio with Integrated Financial Group. He is an absolutely amazing CPA and it's official sponsor of the Nashville Investors podcast. If you guys are real estate investors looking to save money on taxes and make sure that you're properly structured, I think you can speak from personal experience saying that our listeners should go to integratedfg.com and connect with Chris Picurio.
This is another stat. Since 2009, more than 50% of people that are moving into mobile homes are coming from single family. And then again, that just comes back to that whole recession-resistant comment, where as things get tough, and people forget, we've had arguably one of the greatest expansion times in a while, right after the financial crisis, and things are kind of going well. But you've got to remember, I would argue that for a big chunk of the society, they aren't doing very well. And so as things go worse for folks and they lose their jobs and they're in that lower rank, they just have to go back down to mobile home parks because that's the only option unless they want to live out of the car. So that's kind of the demand. They have really low expenses. What Four Peaks Capital Partners, which is obviously the firm I used to work with, their model was they didn't want to own the mobile homes themselves. They would buy the land and then rent out the pads. They're called pads. You would rent those out to the mobile home owners. They would actually sell the home. You can sell a finance. You can make it really attractive, which is what we do. But see, I still say we. This is what we do. But because the owner owns the home, you get that pride of ownership, right? So they take care of their community. They take care of the home. They take care of the community. So our expense ratios, again, I can't get rid of saying our. The expense ratios in mobile home parks tend to be a lot lower than they are in the multifamily, which obviously helps quite a bit. Now, a lot of times, one of the strategies that I like to employ with mobile homes, there are a lot of legacy, what I call legacy owners right now in the mobile home park space. So there's lots of mom and pop owners who inherited their mobile home parks from their parents or their grandparents, and they really don't have the time or the money or really the inclination to improve their thing, right? They live there in the community, they're getting whatever rents they're getting, and they're happy. But a lot of these communities are really dilapidated. They're 40, 50% occupied, and what they need is for somebody to come in and put some money into them, upgrade the units, make the community better, and increase, being able to increase the occupancy. But again, a lot of these mom and pops couldn't be bothered, don't care. So there's a great opportunity to go up there and pick up these, what I call these mom and pop homes, and go in there with the expertise and kind of turn these things around. And by turning these things around, all it entails is really rehabbing the units. A lot of these units, you go in there and they're awful shape, and it's like, no wonder nobody wants to live there or you can't get rents. But you can usually rehab or turn, you guys, how many flippers are in the room? You can typically rehab one of these things in about 30 days, if not less, depending on how much damage there is or how much things. So you do a really quick turnaround, you can really improve the quality of the community fairly quickly and increase occupancy from, Four Peaks was picking up stuff at 35, 40% occupied and then turning them around in about 18 to 24 months and getting them to like 70 or 80% occupied. So your expense ratios, that's where I was going, your expense ratios obviously go down when you do that because there's not really that much additional expenses when you're running a 50% versus an 80%, but obviously the income is much higher and therefore the ratios are lower. We have really great expenses. Now the challenge with the expenses, it's not as easy to find a good property manager than it is to find a property manager in multifamily. Right? So if I'm from out of town, I come to Franklin and I want to go buy a bunch of buildings, I can find a good property manager in town. I can interview them. I can do that. It's a little bit harder to do that in the mobile home park community. There aren't too many national property managers, and so at Four Peaks, we actually ended up creating our own management company to manage all of these things. So that's one of the issues we have with the expenses. But low expenses is huge. It's the imperfect market. Because you have all of these, this is probably one of my favorites on this part, because the industry is so fragmented, there's so many mom and pops, and there's like these little parks to acquire. There's a huge land grab going on right now, where everybody's basically trying to consolidate this fragmented industry. We don't know how long it's going to last, but there's just more and more people, more and more investors are finding out about the space, so people are coming in. That's why we always talk about right now. Mobile home parks is great. Is it going to last another year, 2 years, 3 years? I have no idea. And at some point, I believe that we're going to have our correction. It's coming. There's no doubt about it. It's just a question of when and how hard. And so at that point, when the multifamily start coming back down a little bit, come back to reality, when interest rates will go up, then we may look at multifamily again as kind of a favorite asset class. But right now, at least at the current state, the mobile homes with the imperfect market. Cap rates, we talked a little bit. So cap rates, again, no investor left behind, is essentially you're taking the price of the asset and dividing it by the NOI. You're trying to find out how expensive is it for you to go buy this thing. So a cap rate, let's say it's a 7 cap rate, that just means that's the return I would typically expect if it had no debt on it. That's kind of the return. So a 7 cap rate, I bought it all cash, that's what the NOI is going to be producing, 7% of what I purchased for. These days, cap rates are really squeezed, especially in multifamily. You know, again, once you get to the top of the market, the higher the price, the lower the cap rate. You're getting cap rates. I think Seth was mentioning, what are you getting here in Tennessee, like 3 or 4 or 5% if we're lucky? And so in mobile home parks, we're still seeing double-digit cap rates, which is really phenomenal. I'm going to show you a picture of one that we acquired while I was working with them, and that was an 11 cap and 90% occupied. So there are really great opportunities in terms of the double digits. And also, you know, it's consistent, right? Like the stock, again, I go back to that. I don't want to, Russ bashed it for me, so I'm not going to bash the stock market too much. But, you know, the stocks are so unpredictable, right? It's going to go up, down, is it going to crash? Having a predictable stream where I can put my money into an asset class, and yes, tomorrow it might be 10 or 9, but I know it's not suddenly going to collapse on me, the thing. And then the depreciation is the other. Obviously, we talked a little bit about that, and we can get more depreciation. They are attached to the ground. I mean, it costs 5, 6, 7, 8 grand for them to move a mobile home park. So it's doable, but the cost is kind of prohibitive, which is one of the reasons a lot of residences, when they default on their payments and they want to move out, they typically have to leave the mobile home there. And so it's really easy for us to go in there, take the mobile home, fix it up a little bit, because I'm sure that it's had some dilapidation, and then just sell it to the next person. And typically, typically on these things, when you sell, you know, if you're making less than $600 a week, you don't have 30 grand, right, to go buy a mobile home, right? You don't even have 10 grand. You don't have any money, really. And so the way these get really financed is seller financing. So you've got to basically find out how much money can you afford, essentially, how much money can you afford a month to live in this place, and then design a payment plan around that. Get as much of a deposit you can get, but most deposits are, you know, $500, maybe $1,000, and then you just charge them $200, $300 a month, because that's what they can afford over a 10-year period or 20-year period. So anyway, so that's Clayton Homes. So they do the financing, and then 21st Mortgage is their financing arm. 21st Mortgage has over $8 billion with a B of outstanding loans with mobile homes. $8 billion. And I've met with their folks, and that's why I know the story about Uncle Warren. Their default rates is about 3%. 3%. And in all honesty, you know, we were running the numbers. It's not something we strive for, but when somebody defaults on their loans and they have to move out, it's actually technically beneficial to the owner, because it's very easy to then sell it again. Because again, it's almost like a rental program, because you're selling it to the next guy for $200, but you've got their deposit. You actually make a little bit of a small profit on the turn. But no one's really worried about the default rates, because even if they do default, we actually have Four Peaks actually has a sort of a rent guarantee with 21st Mortgage. So they'll loan the funds, but if for whatever reason they default, the resident defaults, Four Peaks actually covers the rental for those 3 months, because they'll make it up, you know, when they sell it the next time. So it's not a big deal. So Uncle Warren's a big player in the space. Four Peaks was in an article talking about that a little bit. Here's the property that, you know, that was acquired when I was working with them. This is the 11 cap and 90% occupied. Do you notice anything about this mobile home park community that might be a little bit surprising? It's pretty nice, right? Now, in full disclosure, this is probably one of the nicer ones in the portfolio, so some of them don't look as nice. But as you can tell, when people have this mobile home park thing in their head, they're thinking of, you know, trailer parks. They're thinking of just, you know, 8 Mile. Remember the movie 8 Mile? And you're thinking of, like, you know, when I first heard I'm thinking of, like, beer cans, right? You get back home and you got to get the beer can. A lot of these communities are really nice. They're hardworking Americans. They just, you know, they don't make a ton of money. But as you can see, you've got nice driveways, and they look like homes. You know, I think if you didn't know they were mobile home parks, you may not even really realize that they're a thing. So they are nice communities. And what Four Peaks, and what I would encourage you guys to do if you're in the space, is improve the communities, right? Get in there, clean it up, just improve the quality and standard of living, add value to the community, and the more you add value, the more you'll be rewarded. So,
As a real estate broker, I recommend to anybody that's about to purchase an asset, whether it's a primary residence or an investment property, to always get a home inspector to go check that property for anything that might be wrong with it.
Kind of a no-brainer, but it's one of those things that I think a lot of people cheap out on. They want the cheapest guy, not always who's the best guy.
Dave Ganatra with House on the Rock Home Inspections, he will get in there and find every single thing that could be potentially wrong with your place that you're about to buy. I am telling you, he will get in that crawl space, man. He will fight a raccoon for you.
Yes. So you can check him out, Dave Ganatra, at House on the Rock Home Inspections. That's HOTR inspections.com. Again, HOTR inspections.com.
now I have the next slide, which I'll explain why it's in there, but there's a slide here that don't try this at home. I would probably recommend, if you're thinking about the space, I'm sure Robert Helms told the story, but Robert, let me just back up. So Robert Helms is a developer now, right? He's got the largest development down in Belize. But the way he didn't know anything about development, and what he did is he became sort of an investor in someone else's deal, sort of through a syndication essentially. He wrote a $50,000 check, that was an investment. But what he did is he said, hey, I'd like to learn. So he was hanging out with the sponsors, saying, do you mind if I tag along and learn with you? And so when they went to meetings in the city council, he would tag along, and that's how he learned. So investing initially with sort of a syndication where you have access to the manager and tag along and go travel to the site, do the due diligence with them, that'll help a long way. But I said don't try this at home essentially because the key to the mobile home parks is really on the operational side, the management side. So you either have to find a really great property manager, because this is not the typical, single-family home where you get a call with toilets and termites and all that stuff. This is a very specialized thing. So the reason I was thinking, don't try this home. We've got, Four Peaks had a really great construction company, so it was easy for them to go in and rehab the homes and turn them around really quickly. And they have a huge team essentially. So it'll take you a while to develop that team. But once you get into the space and you actually learn the space and get a little bit of experience, the returns are absolutely phenomenal, as you saw with that other deal. So CS at premierlawgroup.net, that's my contact information if there's any other questions you have. I did, while I was working with them, prepare a due diligence checklist, which if you're interested, just shoot me an email. If you're not interested, don't worry about it. I kind of wrote the 5 or 6 critical factors you've got to think about when you're investing in somebody else's deal. So for example, the team. So the team is probably the most important thing you want to think about when you're investing in a syndication. And just make sure that it's not their first rodeo, that they know what they're doing, that they're an expert. But I go through a bunch of them, so if you're happy to give that to you if you do that. And I think that's it. I don't know if you, I'll open it up to questions. I don't know if that made any sense to you.
Good morning. My question is, in the research in this area that I've seen is there are a lot of mobile home parks that are like 10 mobile homes, 15 mobile homes. Do we even consider those?
That's a great question. And I would say, I think it's a great way to get into them, a great way to learn. I mean, when you could probably, if you've got yes, there are plenty of 5, 6, 7 things, and those you can probably just manage them yourself. I mean, it's not something you want to do, but you get the experience, right? When you're managing 100, 200 units, that's going to get crazy. But if you've got 10 or 15, you won't have the economies of scale. Your expense ratios might be a little too high because you've got to pay. The economies of scale aren't there. But I think from an experience standpoint, if you're not going to start, maybe the progression is you start with going into somebody else's deal so you can learn the ropes. Then you kind of get in there with a small part, 5, 6 units. And then once you feel comfortable, you can either hire somebody so they know what they're talking about, and then actually start doing bigger deals. 4 Peaks, we didn't look at anything under 100 units, but that's a great way to get in there, but that's a great point.
So run me real quick, if you can. Let's say you guys, what makes it a good deal as far as like when somebody say, hey, there's this mobile park over here, and how is the process? Do you guys just buy the dirt and then sell the home? Is that where the deal is? Like,
yeah, great question. So what we do, again, I'll say we because it's in my head now. But what we were doing, and still those guys are still doing, is when you buy a mobile home park, it comes with the land and the units. Okay, and a lot of time there are empty pads. So the mobile home community, for example, may have 100 pads. Right, and pads are simply, it's already plugged in. It's not an RV, but it's basically ready for somebody to come set a mobile home and let's just plug it in. Let's just pretend it's that. And so, but maybe it's 100 pad space, but only 50 of them have actual homes on them. And then of the other 50 that are left, maybe 25 of them need some rehabs. And so for those parks, one of the opportunities is because there are empty pads and we had the relationship with Clayton Homes, they can actually bring in new homes and set new homes at almost no cost. They give you sort of the credit, you know, you're responsible for it, but it's almost 100% financing and it's really inexpensive to bring the pads up. So that's one easy way for us to get more yield from the property because we just add. And then with the construction company, the other 25 that needs to be rehabbed, we'll rehab. But what we do is we buy them and then we sell. We're not in the rental business, right? There are some people who have that model, and that's great, but that you tend to see higher expense ratios when they're all renting, when they're renting both the home and they're renting the space. And so we immediately do a process where we turn those rentals into home ownership. And one of the challenges you have sometimes when you're acquiring a property like this is the lending. I know there's a couple lenders in the room, but lenders don't like to lend on the homes themselves. They want the land. Right? Technically, in all honesty, mobile home parks, mobile homes themselves, the homes, are not really real estate, technically, because real estate is not attached to the ground, it's movable. So technically it doesn't qualify as real estate. And so traditional lenders don't like to have too much of a high ratio of the park owning the homes. And so because of that, you've got to get a little bit more creative on the finance. Sometimes you buy them all cash. You convert the homes from rentals to ownerships down to a reasonable level. Maybe it went from 80% that's owned by the.
It's not a buy and hold strategy with what you guys do over there. It's just you get in there, you acquire it, you improve it, you sell it. Owner financing. You said
we sell the homes themselves.
The homes.
So the plan is to keep the land. There's no real.
You keep the land.
To sell the land.
Okay.
But we want no part of the homes themselves. We want owner occupied. We want people who have pride of ownership that take care of the units. But that is financed. So
right.
That's another issue at some point you get. So you either have to raise the money to go do the loans, or you just do it yourself. But then you kind of run out of money. And this happens a lot in real estate in general, people that do seller finance. So then you end up with a bunch of notes, which is great because they're producing income, right? The seller financing notes. But then you can actually package those and sell those to a bank or something if it's stabilized and it's returning consistently. And these guys pay, by the way, on the loans. They don't even care what the interest rate is. You typically pay about 10 to 12. They usually pay 10 to 12% on the seller financing, which is great. So it makes it a little bit easier to raise money because I know that if I raise money and I put it into a loan for a mobile home, that I'm going to be getting 12% return on that money, and there's a little bit of expenses. Somebody's got to service the debt, but essentially I can then give the investors a 10 or 11%. And Four Peaks was guaranteeing that because they knew that if they, for whatever reason, defaulted, they could cover the payments for the next 3 months. In the meantime, they're selling to somebody else, doing it again, and they'll be back to square one within 3 or 4 months.
I was going to ask about the default ratio. As far as is there a big default?
No, it's 3. We haven't actually. When I was there, we didn't have that many defaults. I think for us it was around 5%, but Clayton Homes is 3%.
Wow.
Every now and then I get a phone call from a client and they're trying to find financing for a gas station or something unconventional like storage facility. The first name that always comes to mind is our great sponsor, Billy Brown.
BillyBrown.me. That's BillyBrown.me. He is a fantastic creative lender.
Correct.
And can help investors just like you solve any creative lending issues. Maybe you have bad credit. Maybe you have defaulted on loans in the past, or maybe you just don't have the history operating properties to be able to qualify for a big Fannie Mae or Freddie Mac loan.
They're great at just focusing on the asset more than the borrower himself. So, call him to pick his brain. He's always willing to talk to anybody. You would love just talking to him and finding out about different ways to be able to finance your investment.
Yeah, so Billy Brown, that's BillyBrown.me. Check him out.
With respect to owning the land and the property, is there an extra component for insurance, whether or not you're financing the homes themselves, or is that just all on the homeowner anyways?
That's on the homeowner. So we insure the land. And there's so much, and I wasn't too involved in the insurance side, so that's not my stronghold. But this pretty much the same insurance that you would get on a multifamily, the same types of insurance you would get apply to mobile homes. One of the big ones we like to get is the loss of rents insurance. So just in case there's because one of the things we got lucky, we haven't really had a big issue, but one of the issues, because a lot of them are in mid-America, right? You're not going to go to Manhattan and buy a mobile home park community, or you're not going to go to California, even though there's a lot of California ones. The numbers don't typically make sense, but we were usually in kind of Middle America, Southeast America, and you get hurricanes. You get tornadoes, you get stuff. So potentially those have an opportunity to disrupt you. So you would definitely want to get the insurance through your insurance broker, but also loss of rents, because even though it may not be your home, that's income that you're losing during that time period where the tornado took out the home, and you've got to go in and either put a new home in, or probably at that point, if it's completely destroyed, you'd call Uncle Warren and he'll come down and put a new home down there. So.
Okay, so as far as doing like the owner financing, where are you going to pull comps to say this house is worth this much, this one's worth that much? Because I'm assuming that normal, traditional, you can't go on Zillow and say, hey, what's this mobile home worth?
No,
so.
there is actually, and I forget the name of it. There's a company out there, I forget the name, so forgive me, but it's similar to sort of the Kelley Blue Book, because again, it's not really real estate, but it's just like Kelley Blue Book has what's the worth of your car. And I forget the portfolio. You find 2 or 3, and you just want to raise the entire amount. So that's one thing that you would raise money for, just like any other real estate deal, for the equity, and then you get a loan, or maybe you're buying it all cash, or what have you. The other syndication you can do, as we mentioned, is the lending arm, right? So one of the things I didn't talk about, I guess didn't clarify, is that Uncle Warren only lends money on like nicer homes. So I think their criteria is they don't loan on anything that's older than 10 years. And so the newer homes they will finance, but there's all these homes that are worth 3, 4, 5, going to value, at least book value, 3, 4, 5, 7 grand that they won't touch. So we do we basically raise money into our own lending company and then have that company lend out to do the seller financing. The other thing you need money for is just rehabs, right? A lot of this it's money to go in there and turn these things around. You need a construction budget to rehab the units. You want to add new fencing, cut back the tree, and there's a whole what we call a CapEx, a capital expenditure that takes into account. You can either include that in your raise on the property, or what we like to do is raise that, again, same thing. You can offer some pretty attractive rates to investors, especially IRA folks. I mean, they don't want the money. You're offering them 10% return, like basically guaranteed loans. They'll do that all day. So we raise money for that as well. And there's, I think, a couple that I'm forgetting. But yeah, it's just like any other asset class. You're raising the money for usually the down payment. And if there's too many park-owned homes and you have to buy it all cash, then you just raise the money all cash with the understanding that you're going to refinance out. And the banks usually want about 2 years of stabilized rents. So if it takes you 18 months to turn that thing around, and then another 2 years of seasoning, maybe in 3.5 years, you get to refinance. And again, by then you've increased so much value that you're not only returning the investor's original capital that they put in, but then they stay in the deal. You may even get to a point where I'm returning your money plus more, but then you remain in the deal. You continue to receive rents even though you've got all your money back. And so in that case, your return actually becomes infinite, because you've got no money in the deal and you're still receiving cash flow from the project. And then you can use that money to go do the next deal, just kind of recycle that money. When you have that model where you're going in with the construction company and just being able, you can do anything with anything. So as long as the numbers make sense, and so here, I guess here's a good aha. So let me tell you a good aha. So one of the things you'll realize when you're doing mobile homes is 2 things. One, there's a lot more cash transactions, because a lot of these guys don't have bank accounts, right? So they're paying you in cash, which is fine. It's very difficult to get real numbers from the seller, right? Because with a multifamily, you get rent rolls, you get, there's a due diligence that you can do and figure out, that what this person's telling me is legit. But when the guy's taking in, not all of it, but maybe 20% of the income's coming from guys who don't have checking accounts, so it's just cash every month, they're keeping a ledger, right? Like on maybe it's an Excel spreadsheet. And so it's just very difficult to really believe them, or there's no way for them to prove, like, yeah, this is how much money we're actually, as it stands right now, how much money. So the data is imperfect. But that, again, and they don't go back and reorder. I mean, this is one of my big things. I said, hey, look, we found out that the income wasn't as high, or they couldn't show us the income. And me being the lawyer, I'm like, well, the price has to come down then, because we entered the contract at this price based on this assumption, and it turns out the income's less, so we should read it. And that's what you would do in a multifamily. But these guys aren't going to do that. This is what they think their property's worth, and they probably think it's worth more. But again, there's so much meat on the bone for these types of deals that as long as you're comfortable that you can go in there, turn those units, increase the occupancy, and the numbers make sense, it really just at some point just becomes a price. You obviously don't want to pay too much for it because at some point it doesn't make sense, but reverse engineering, if the numbers are there, we grab it. And the only reason it's 100 units is the economies of scale. I mean, if you do 50, you're just going to...
So what's the timeline that you guys go in looking to get in, refinance, value add, and get out?
Well, we don't, on the land portion, our plan is to always stay in forever. So the first exit strategy is the refinance. So that'll at least get you your money out, right? So you got all your money back, maybe a little bit more, and you're still getting cash flow. Then what we tend to do is we will, because people do want an exit strategy, at some point they want, or they may want to come out, or so usually within 7 to 10 years, we don't want to sell it. And these guys haven't been around that long, so this is all in theory right now. But the idea is they will actually go raise another fund to go buy the property out from the current investor, so that's an opportunity for them to get out. But from Four Peaks' standpoint, and from, again, we talked about all the, my goal is to accumulate as much equity and then cash it in. I would want to hold that on until I'm done, and I say, hey, it's time for me to go on my boat and, travel the world. And I'll cash everything in. I'll 1031 exchange into one or two huge, 300, 400, 500 mega unit apartment complexes that are just spitting out so much cash that that's all I need to live on.
I just have one question that's maybe outside of this space. Have you looked at any mobile park communities that are more of a getaway, like a cottage style? Or are these strictly residential homes for people to live in?
These are all residential homes. I can't imagine you want to do, I'm missing something. There's no way I'd want to do a getaway at a mobile home park.
Where that comes from, because I'm from Canada, and we used to have a mobile park, a mobile home, but it was like on a lake. So it was like not a residential, like this is my primary living. This is like a cottage. So it's got the Florida room. Everybody's got their own property. It was the same style of park, same style of mobile home. It just was more of a vacation spot.
So 99.9% of the time, no, everyone's residential. But it just reminded me that anybody from California, have been to California? I think you obviously. So in Malibu, right, which is the most upscale, there's actually a mobile home community on the beach. And my understanding is those mobile homes go for $1 million. And you're not buying the land. You obviously don't own the beach. So I don't even know how that works, and if it's a 99-year lease, I don't know. But yes, in those cases, I'm pretty sure those are really nice. And they're on the beach, but so that would be potentially a getaway. But that's not obviously not that's not the guy making $600 a week or less, right? Those are probably second homes, and you can't beat being on the beach. But 99.9% of the time, this is just affordable housing that's just in such a tremendous need. And it's kind of a little bit of a feel-good story because you're obviously providing much-needed housing for folks and improving their community. So it's got that nice ring. But yeah, other than Malibu or your getaway, I don't see, why people would go do a getaway in a mobile home park. But so if it's in a great location, on a lake would be a great example. Yeah. None of these real estate should be in your personal name. Let's just start with that. Okay, you have to put those real estates into some type of an entity, and 99% of the time it'll be an LLC. Now, the LLC, limited liability company, as you probably know, can be taxed any way you want. So if for some reason you want that corporation tax for whatever reason, you really want to get double tax and whatever, but sometimes there might be a reason, or if you want an S Corp because that's passed through and there's some tax benefit, you can have an LLC and tax it as a C Corp. You have an LLC and tax it as an S Corp. You can have an LLC and tax it as a partnership, and if it's just you, it's probably a disregarded entity, so it just shows up on your tax returns. So that flexibility is really what it is. In Canada, they don't recognize limited liability companies, so they get, if you set up an LLC, and this is my understanding, they'll get double tax over there. So typically, you want a limited partnership. But in my world, a limited partnership and a limited liability company are almost identical. It's just a structural thing, but they both serve the same purpose. So mobile home parks are always purchased in an LLC. At least the property will own the LLC, and then it's just a question of figuring out who's going to own the LLC. If it's just you doing it, then you would probably have another entity, a holding company, for asset protection purposes that would own it. Do we have time? Can I spend 2 minutes on this, or are we low on time? I don't even know what time it is. Okay. So when you're thinking of let me just do this since you guys didn't all see. So when you're doing asset protection, and I'll just go through maybe a single family or whatever. So there's really two things. So you've got Europe here. Is that even? I don't know what that is. And then you've got your house, right? So there's two things you always need to worry about with asset protection, and I don't know which one you think more than the other. So the first is, what happens if something happens to the property? Your tenant slips and falls, your balcony in your apartment complex collapses, a tornado comes through your mobile home park and kill some, whatever. So it's an attack on the property. In the U.S., the owner of the property is legally responsible for that injury. Okay? So when we put this into an LLC, inside an LLC, the owner is the LLC, and so the LLC is the responsible party. And so whatever's inside that LLC is fair game. If I get a judgment, if I slip and fall and I get $1 million judgment or what have you, I can go after the owner, and the owner will typically have obviously the property, so whatever equity is in the property is fair game. And if there's bank accounts which there should be, whatever cash is in there, and anything else it owns, right? Which is one of the reasons you want to think twice about putting 2 or 3, 4 properties in one LLC. If the LLC gets sued because somebody slipped and fell on property number 1, they can go after the equity in the other properties. So ideally, you would put each of these properties in its own LLC. The challenge with that is cost, and so at some point, you've just got to figure out what's the best, whether you want an insurance company, because if you're buying a $120,000 unit and it's making $200 a month, nobody's going to get rich off that. You want to get more of those, but it'll be a cost issue. So that's number one. The second issue you need to think about is what happens if something happens to you unrelated to your assets. You get into a car accident. You leave here and unfortunately you back out and you hit a kid on a skateboard, or you run over the little old lady, or you just get into a business dispute. Now there's a judgment against you personally. Okay? And now I'm like, well, what assets do you have for me to go after? And not to bore you, but the whole reason for that is if you're in a business with someone and I come in and I've got a huge judgment against one of your businesses, you don't want me to come and take over your business's assets and control. Now I own 50% of the company and I'm stuck with a business partner that doesn't care about the business. They just want to sell it and get paid. So that's the policy around it. So that's why you don't get actually ownership or control. But if it's just you, that rationale goes out the window. If it's a husband and wife, that rationale goes out the window. So most of the states won't give you that charging order protection. They'll actually give the creditor your entity, unless you're in one of those 3 states, because those are really business-friendly states.
Got a question from one of our online viewers.
Wow, our sole viewer has a question. Right?
Yeah, exactly. She's got a question for you. Lori says, do you have to be an accredited investor in order to get into a syndication or invest in a syndication like this?
Is it Lori?
Lori.
Lori. Hi, Lori. Great question. So an accredited investor is anyone who has over $1 million in net worth, excluding their primary residence, or somebody that who has earned $200,000 a year for the last 2 years with a reasonable expectation of earning that this year. That's what an accredited investor is. If you're doing a syndication, Lori, you can take non-accredited depending on the exemption. I don't want to get too into the weeds, but when you're doing a syndication, you're basically dealing with securities laws, and there are several exemptions that we rely on. And depending on the exemption that we pick, we may or may not be able to use non-accredited investors. Most of my clients use an exemption that does allow you to take up to 35 non-accrediteds, but then you will be prohibited from advertising. So if you're not going to advertise and you're just going to raise money from your friends, your family, your foes, people you already know, you can technically take up to 35 non-accredited investors. However, if you're advertising and we're dealing with a different exemption, then you may be limited to accredited investors only. But it is possible, and in fact, most of my clients do have non-accredited investors, so I'm very comfortable working in that space, but you're limited to 35.
Hey, thanks for learning with us today on the show.
We would love to meet you at one of our free monthly meetups in Middle Tennessee.
Hit the thumbs up button if you like the content. Make sure you hit subscribe so you don't miss a thing on this channel.
Check out another awesome investing video here.